Hi, I'm Tom Stelzer from Livewire Markets, and today I'm joined by Eric Fine from VanEck to discuss all things emerging markets. Thanks for joining us, Eric.
Good to be here, Tom.
Eric, if we could just start by utilizing your global perspective. Obviously, there's a lot happening in the world right now. What would you say are the three most important factors that you're paying attention to?
Yeah, I think the three things to focus on, if I had to pick three, would be number one, U.S. Treasuries, especially the 30-year. Rising 30-year yields price all the dollar-denominated bonds in the world, essentially. But moreover, they create fiscal risks in the U.S., and it sets up next year very interestingly, right? New Fed governor, what will be interest rate policy, and will it be aimed at inflation or will it be aimed at reducing government borrowing costs, which are completely different things. So that's number one. Number two, I think this is a major sleeper issue. It's arguably the most important thing going on in the world, CNY. Since Trump got elected, the daily fixes have been stronger than the bank predicted levels. FX has been incredibly stable. If that continues, or if CNY revalues as we expect it to, somewhat unusual view, that reprices global FX, especially in my world. Asia gets repriced, but also Brazil, Mexico, Chile get repriced. So that's the second one. The third one, sort of a combination, is the combination of asset price moves during short periods of time. It's bad enough when U.S. interest rates are going up and the dollar is going down. Just like a couple years ago in Japan, interest rate up, yen down. That's bad enough, that's an exit. But when it's interest rates up, dollar down, and stocks down, that's an even broader exit, potentially. Related, this year we've had a number of reactions in which euro up, yen up, Swiss franc up, gold up, and South African rand up, Malaysian ringgit up, Mexican peso up, Brazilian real up. So those are the three basic things I'd look at. Treasuries, especially the 30-year, CNY, but also these relationships that tell you where money is going and where money's leaving.
Maybe in contrast to that, what's the one factor you think markets are maybe focusing too much on at the moment?
Yeah, for 10 years we've been saying that a lot of developed market countries and their bond markets are subject to fiscal dominance. Governments have too much debt, your central bank can't be independent, so you're going to have an inflation problem. And it had been somewhat of a taboo subject to discuss the status of the dollar or treasuries as a reserve asset. In the last 6 months, that's not a taboo topic, and I think that's overdone. I think the right attitude is the dollar is not going to lose its reserve status, but it will share it with other deserving currencies like CNY, which is clearly the Chinese government's plan.
You just mentioned it then, US Treasury bonds, the US deficit back making big news at the moment. How do you see that situation playing out?
So broadly speaking, it's a big problem, and it's very hard to be hopeful, particularly because interest expense is such a large component. And there's a little bit of a bias that this stuff never matters. Moreover, an implication could just be dollar weakness, which to most U.S. citizens and also investors wouldn't even notice a 20% drop in the dollar. Hard to be hopeful on fiscal in the U.S. However, under a reconciliation discussion, which is what's happening, how the budget's being moved forward, you're not allowed to talk about non-discretionary spending cuts. So those will be follow-ons. There could be positive developments on those, the famous DOGE, Doge efforts. So there's a chance that happens, but it looks as if the general path is not changing at all. The Congressional Budget Office scores this as a deficit increaser. Now, we'll see. That's another source of hope, is that the growth rate assumption in CBO could be too low, and that the fiscal results get better. But it's really hard to expect good results from U.S. fiscal, which means the real action is going to be the Fed. If it's too hard for fiscal policy to get interest rates down, or impossible, or the government just chooses not to do it, and if the current Fed governor, Chairman of the Federal Reserve, Powell, remains more tilted towards inflation risk than recession risk, then we're waiting for next year and a new Fed, Fed chairman. And the expectation is that there's going to be an accommodation, how it gets described and how it proceeds. But that is classic in situations of fiscal dominance. When you have too much debt, the pressures on the central bank, and central banks do not bankrupt their governments.
Moving on to emerging markets, you head up the emerging markets fixed income team at VanEck. What's your view on the current macroeconomic backdrop for emerging markets?
Never been better, but we've been saying the same thing for 10 years. EMs have low debt. That allows their central bank to be independent and pay high real rates, keep their currencies strong, and that just keeps continuing. We said it 10 years ago. And the performance backed it. We just needed to observe what EM bonds did, especially dollar-denominated bonds at that point. Said it 5 years ago. We just observed what the previous 15 years looked like. EM bonds did well. And right now, or let's take us to January of 2025, we had the same view, and we were saying it was going to spread to local currency bonds. One of the most interesting things that happened in the last 5 years is that even though EM local currency bonds had a lot of volatility, and we didn't generally like local currency, we did like Asian local currency. And in the last 5 years that have seen a number of developed market crises, from Credit Suisse to Silicon Valley Bank to the Japanese yield curve control to the Liz Truss moment in the UK, the oldest bond market in the world, what's happened? Asian interest rates on their bonds have gone to zero relative to the US. And some of them are lower yields. Chinese yields are lower, but still high in real terms. So I think it is not so much a story of EM doing great, because you just need to observe the performance of their bonds over the last 20 plus years. What's really changed and what's really helped EM is this is no longer a difficult story for a lot of investors. In the US, Europe, Australia, daily investors are reading about risks to US fiscal, risks to US monetary, the status of the dollar, why are central banks not buying treasuries anymore. It's become a much more accessible story. It's no longer explaining that that's the case and the EM bonds have already done well. It's now answering them when they ask and saying, yes, that is the case, and the performance continues and is actually accelerating. This year, local currency in the US, so in US dollar terms, is up 10% just year to date, local currency bonds. Now that's the FX and the rates. So that's, I think, the big change is investors' awareness is following the most sophisticated investors' awareness in the world, which is the central banks, which have been doing this for a long time. But I think that's the biggest change is investors now understand that this is a very reasonable topic.
I think you've previously said that emerging markets are the new developed markets and vice versa. How do the two differentiate at the moment?
EM keeps acquitting itself. It's really hard to change these strong fundamentals, right? A low level of debt, especially populations, voters in these countries that do not think that it is ever the central bank's job to harness a central bank to generate economic outcomes, because in Mexico, they killed the banks. They killed, inflation is a killer of the poor. So those aren't options. So that continues to be the case. It's deepened. The reason I give the political example is random example. Claudia Sheinbaum in Mexico, new president of Mexico, a leftist politician in terms of the normal political, framing that you use. We don't care about issues other than the economic ones. 80% popularity, fiscal austerity, central bank independence. So the big new thing is the growing realization that China is going to have a new global reserve currency. Just today, the PBOC came out re-emphasizing or elevating their plans to internationalize RMB. Now they're using a digital dollar. I think that's getting a lot of the attention, but having an alternative reserve currency that's not the dollar is a really significant development. And it's a reminder that there are multiple reserve currencies. It's not just treasuries, and that this has already happened. Malaysian ringgit, Korean won, Sing dollar, those are all legitimate reserve currencies. They're not just buying gold. They want something with yield, and China becoming a reserve currency, I think, is now the next stage, the next anchor.
Yeah, I mean, it seems the tide may be turning there, even just in the way that people, I suppose, think about, those kind of markets. But how would you say, some of the recent events, tariffs, the geopolitical situation, what has been the impact there on emerging markets?
Great question. First, let's talk about geopolitics. We in the West see geopolitics and we say, oh, the world's deglobalizing. What a crazy world it is. Not if you're an EM. The biggest fact on earth is every pipe in Russia is being built eastward to India and China. So India and China buy oil at a price, I don't know what the price is, $20 lower, right? So that's a positive terms of trade shock. So geopolitics are not adversely affecting EM, and to the extent that geopolitical risk gets commodity prices up, my countries are often commodities exporters, so they win from that. On tariffs, great question, really important. I don't think it is properly framed or understood. The US administration is not focused on tariffs. Tariffs are a tool to a discussion on much more important things. Tariffs are on what's called your current account. I sell shrimp, I buy toys, or I sell you a service, or even pay you interest, and we tax it. That's called the current account. But the balancing account is called the capital account or the financial account. And the problem has always been US investors can't buy a bunch of Chinese farmland. Chinese can buy all the US farmland they want, for example, just to pick an emotional, kind of issue. That is the objective. And that's not allowed under WTO rules. How do you start the conversation? No one in the market likes destabilizing negotiation tactics that are extreme because it creates volatility, but that's the tactic they chose. And I have no control on it, and it is what it is. But these extreme levels of tariffs are not designed to actually tax current account transactions. They're designed to, number one, have a discussion on the capital account. I gave you the example. And number two, tax. So I have a car in the US. It's a Ford F-250 diesel. Really like it. That car is like $300,000 in Norway, right? In the US, it's less than a third of that. And it's those issues. And that has been an issue since the Obama administration with Europe, right? The famous VAT. So tariffs are designed to get into those two conversations that are not part of WTO. So I wouldn't get too hung up on thinking about it as tariffs. Now, so that's number one. Number two, I was a sell-side economist for a long time, and most of this year, every economist has looked at it the following way, and I understand because I would do this exercise, but I wouldn't believe it, or I wouldn't use it as my framing. They're saying, oh, China's been generating these mercantilist surpluses for decades. They need manufacturing exports for jobs. And, I'm told they're tariffs. Okay, I'm going to calculate how much they need to devalue in order to keep those exports, in order to keep those jobs. That's not right. Why? There is a currency chapter in all of these discussions. And those are always secret. Right? Currency is, just trust me, but you can look at the Plaza, Louvre, all these accords. You find out months or years later. And those are for big countries. On the bilateral basis, you may never know what the currency arrangement is. But if that's true, then just use the example of China. US negotiating with China, currency chapter. Your currency has to be stable, maybe stronger. Well, what are you going to do if you're Chinese and you're up to your necks in dollar assets? Dollar stocks and treasuries, among other things. And you're told that the dollar is going to go down. You're going to reshore those dollar assets and bring them onshore or to other non-US shores. And if that's the right way to look at it, then the economic exercise one should be doing is look at the accumulated mercantilist surpluses that have been piled up. And the most basic way, and you see this in popular media now, is the NIIP, the Net International Investment Position. Does Korea own more of us than we of them? Yes, and so it's a big positive, and so if that's the case, that's a reshoring argument. That is I'm getting out of my dollar asset and bringing it onshore or to other non-U.S. shores. That's the big dynamic. I'll give you a very precise example. Because of the NIIP, which means the U.S. is very dependent on offshore funding for its bond market, famously Japan and China, own a few trillion between the two of them of U.S. bonds. If you're a Japanese investor and you buy a 10-year U.S. Treasury and hedge it into yen, you're getting 40 basis points. If you just own the outright JGB, you're getting 4 times that yield. So this is not something that a headline is going to change. This is in the plumbing, and I think that's one of the most important things going on. Excitingly for us, this was basically non-existent view, other than a few people were happy that we arrived at this view early. But you see a pylon, right? The fact that no one else bought into it, if it's happening, just means the rally and the implications are going to be even bigger, because if there's great reluctance to accept it, it just makes me happier. It means the value is on the table for our investors longer.
I think that leads nicely into identifying the opportunities in fixed income in emerging markets. Where are you seeing those opportunities? What countries, what regions right now?
Overall, in local currency EM bonds. So we're a blend fund. We invest in everything in EM bonds. So we invest in local currency bonds and dollar-denominated bonds. And our big view is that local currency EM bonds have a lot of upside. So in general, our fund is carrying around 7%, but 60% of the portfolio is exposed to local currencies that could add to that return. That's one big view. And on spreads, so the dollar portion, that's 40%, we are absolutely uninterested in generic spreads. 200 over for Brazil is not where you want to be. You want to be at 14% in their local currency market. Generic spreads, number one, everyone in the world is long corporates and U.S. spreads. 40% of U.S. investment grade is owned offshore, subject to the same problem that I described in Japan. And so in dollar bonds, we do not like spread duration. We want short dated, and we want to get paid. We do not want something that is going to be a pure correlation with U.S. high yield or U.S. IG. We want Ivory Coast, Nigeria, or Ecuador, several hundred basis points over treasuries, and real lack of correlation with those sorts of risks. So that's overall. The specific countries will change over time, of course, because they get expensive, they get cheap. But Brazil, Malaysia are among our favorites, and South Africa. Brazil, Malaysia, and South Africa in local currency are among our most exciting places, and also China. Not just Chinese currency, because they do pay high real rates, and there's revaluation risk in CNY. We think CNY could go from 7.17 to 6 in the next 5 years, which would reprice everything. But also, we were fortunate in that we have a process that only buys cheap things. We never bought Chinese property bonds when they were investment grade at 100 cents. But after that market collapsed, there are really neat, very cheap, you have very special opportunities. We don't have a lot of nominal risk in it, so a few percent, but they're so cheap that they do a lot of work. So I'd add China to that list.
And just in terms of finding those opportunities, what factors do you use to assess the credit quality in emerging markets?
We start with a purely quantitative process where we look at 15 fundamental metrics that are things that your viewers would hear of. So your government debt to GDP. We line up all the countries, the ones that have the best fundamental metrics, the ones that have the worst fundamental metrics, but we're not interested in good and bad. We're interested in cheap. We compare those fundamentals to their yields. And if the yield is too high, we like it. Now, the world doesn't always work that way, so we have a second step in which we capture non-systematic risk, an invasion, index exclusion. And there we make judgments, and if we think that despite cheapness, there's some problem that you shouldn't build a model for, it's not subject to programming, we kick them out.
And do you think there's any risks or red flags in emerging markets that investors should be aware of at the moment?
Yeah, I think the two big risks, the first one's going to sound a little cheeky, but the first risk is that the United States, Japan, and UK get their acts completely together. Cut spending, tell the central bank, do what you need to do on inflation, allow banks to suffer pain, right? Allow recessions. You can see why that's cheeky. I think the odds of that are extremely low. There's no evidence of that happening. So that's one. At the end of the day, though, we're bottom up. So the big risks are going to be in specific countries. In none of them do we see the possibility of contagion, but Colombia seems to be a D-rating situation. I don't see that as bad for EM. I see that as a reason to be cautious on investing in Colombia local currency. Indonesia we like, but it's not a super high conviction situation. It's a bit of a, they're not fully ready for prime time. So that could be one. So our answer's almost always going to be very specific countries, but in general, EMs are very weather conditioned. They have been beaten up. If you've survived this long in EM, your policy framework, you're doing a lot right. So I would say there are definitely some countries you want to avoid, but the main ones you want to avoid are the developed markets where all your bond exposure already is.
And in terms of your funds, how has the performance been recently and what has driven that performance?
Yeah, so according to Morningstar, EBND is the best performing bond fund in Australia for 1, 3, and almost 5 years. The strategy's lasted longer in the US, and it's top quartile, sometimes top decile out to 7 years. So performance has been fantastic. The interesting thing is that's often not enough. It's not enough to just do really, really well. Might seem strange, might not be. I would say the big things that could change attitudes are, number one, stocks not being 20 to 40% a year, right? That'll, I think, be a big door opener. And also recognition that the global ag and treasuries have not protected you. This basic thing of rates going higher and the dollar going lower is really hard to overcome, right? And there's only really one way to overcome it, which is to find the exact opposite. What's the exact opposite? Well, if the dollar's going down, something's going up against it, and it's our currencies. It's of course euro and yen, but we've already sort of given our thesis that fine, euro and yen can go up for a year or two, but the real thing is avoiding those developed markets and being in the EM markets where their rates are going down and their currencies are getting stronger.
And finally, a bit closer to home, the hybrid market here in Australia is getting closed down. Where do you think investors should be looking for alternatives?
EM bonds. Hybrids were always a bit of a curiosity to an economist, right? Because it's kind of EM-y, right? You don't have something that's a bond and not a bond. It's risky. It's risky and it's wrong to misattribute risk, right? If you're doing it, you should. In general, anyone with my experience is going to say you almost never invest in bank debt. It's got the upside of the government bond and the downside of a stock. And so I think it's a really healthy development. I understand why policymakers are encouraging or swaying Australian investors in that direction. Australian policymakers are the heroes of the economic textbooks I grew up with. All these reforms you did that created the superannuation system here of forced savings got you guys out of the same vicious cycles that a lot of my countries were, where most of their debt was dollar denominated. So I think it's a very healthy development. And I also think Australians probably understand a lot more about EM than they realize if they look at their own history. You guys wrote the textbook. Chile almost copied and pasted it, right? New Zealand and Australia. So I would encourage people to look at it that way. And Australia's been a success story.
That's all we have time for today. Thanks for joining us today, Eric.
Thank you, Tom.
Thanks for tuning in. Make sure to check out LiveWire's YouTube channel for even more videos.